Look at the sheer scale of this infrastructure. This is Glasshouse Brands, the producer behind the largest greenhouse cultivation footprint in California's market. They operate out of California, which holds the title as the largest and most lucrative legal cannabis market on the planet. But that dominance was interrupted when sudden federal immigration raids struck their Camarillo and Carpinteria facilities, halting operations overnight. When the largest producer in a regulated market takes a direct hit to its core operations, it raises a crucial question about the durability of the entire enterprise. For investors, this acts as a real-time stress test. The reaction of Glasshouse's supply chain to this pressure demonstrates how external shocks impact the broader legal industry. To understand the damage, you have to look at the business model. Glasshouse relies on vertical integration. They control every step of the product's lifecycle, from seed to register. Upstream handles cultivation and manufacturing, processing raw materials into brands like Plus Products and Allswell. Packaged goods then flow to retail storefronts, feeding dispensaries like the Pharmacy and Natural Healing Center. The vulnerability of this setup is straightforward. If the upstream cultivation falters, there is nothing left to push through the pipeline, effectively starving the manufacturing and retail segments of inventory. When operations are running smoothly, vertical integration captures maximum profit. But during a federal crackdown, that interconnected supply chain becomes a liability. The severe upstream labor bottleneck sent an immediate financial shockwave straight through the core of the company's balance sheet. Glasshouse generated a healthy $10 million net income profit in the second quarter of 2024. By the third quarter, following the raids, that reversed into a $3.2 million loss. Updating the chart to the first quarter of 2026 reveals the prolonged impact. Top-line revenues fell to $40.5 million, slicing gross profits down to $10 million, causing severe margin compression. Adding to the strain, the company absorbed an additional $6.3 million impairment expense on goodwill and intangibles, dragging down the balance sheet even further. Despite the bleeding, they survived the quarter. Their lifeline was a robust $35 million reserve of cash and equivalents heading into the end of 2024. That capital buffer prevented bankruptcy in the face of a severe structural shock, though the cost to their profitability was steep. When management addressed investors during the Q3 2025 earnings call, they had to outline exactly how they planned to navigate the resulting operational vacuum. The root cause of the slowdown was labor. After the raids, Glasshouse was forced to terminate its relationship with two major farm labor contractors, severely limiting their ability to harvest. The resulting drop in output is visible in their adjusted guidance. Management slashed full-year revenue expectations from $230 million down to a range of $190 to $195 million. Yet the call also highlighted specific tailwinds. Despite the cultivation issues, their retail and consumer packaged goods segments consistently outperformed the broader California market. To recover, Glasshouse engaged new contractors, projecting that increased staffing would double their fourth quarter production and hit record acreage output by 2026. Leadership presented the crisis as a temporary bottleneck on their path toward the record acreage and production targets set for 2026. Glasshouse Brands now sits at a definitive crossroads, giving the market two distinct ways to interpret their future. The bear case focuses on their exposure. They are highly vulnerable to federal regulators. Their margins have been compressed, and relying on volatile local labor forces presents a constant systemic risk. The bull case points to their endurance. They maintain massive cash reserves, boast an insulated retail network, and could secure a firm stranglehold on the market if they successfully hit their 2026 production targets. So, looking at the data, you have to decide, are these the growing pains of a massive vertically integrated producer, or the beginning of a downward structural spiral? Let us know your thoughts in the comments. If you found this breakdown helpful, be sure to subscribe. As always, this analysis is for educational purposes only and should not be taken as financial advice.